In today's video, we will uncover the key principles of investing, from setting goals to staying consistent to managing market volatility and, most importantly, keeping our emotions in check. Stick around because by the end of the video, you will have a clear roadmap to becoming a confident investor. Investing in equity markets can definitely feel overwhelming. Too much information, endless options, and that fear of making mistakes. Sounds familiar, right? Well, you're not alone, I would say. But here's the good news: starting your investment journey doesn't have to be complicated or scary. In fact, with the right mindset and a solid plan, it's one of the smartest decisions you will ever make. So, without further ado, let's get started. So, first things first, why are you investing? Are you saving for retirement? Building a down payment for a dream house? Or maybe you just want to grow wealth over time? Whatever it is, whatever your cause may be, your investment journey begins with a clear purpose. Why does this matter? Because your goal determines your strategy. A short term goal like buying a car in 5 years will require a different approach than saving for a retirement maybe in 20 to 25 years of time. Without a clear goal, you will be finding yourself, doing investing blindly with a confused state where you are indecisive and eventually get frustrated. So take a moment, grab a notebook, and write down your why. Trust me, it will make a difference to your overall investing journey and will help you get started in the right way. Next, let us talk about one of the most important aspects in the investing world: consistency. This is the secret sauce to investing: consistency and discipline. It's about not finding the right stock or mutual fund with the highest returns last year, but it's about staying over the course of whatever path you have chosen, staying consistent with that even when the waters get rough. Think about this example of Mr. Peter Lynch. His Magellan fund delivered a jaw dropping 29% annualized return. Yet, most of its investors lost money. Why? Because they panicked when the fund underperformed temporarily and sold at the wrong time. Don't make that mistake. Pick your investments wisely, commit to them, and keep investing regularly even during market slumps. I'm not at all saying over here that pick a script without any research and just keep staying invested in that without any reason. But what I'm saying is, once you have done your due diligence and invested in it with a specific mindset and a specific goal in mind, and you have full trust in the mutual fund or the stock or the portfolio that you're holding, stay with it. Market slumps are supposed to happen. And one more important tip in this: build an emergency fund before you start investing. Set aside at least 6 months of living expenses in a low risk liquid asset, in a fixed deposit, in a saving bank, whatever makes sense for you. Fixed deposit makes the most sense according to me, but choose yours as per your requirement because that will give you the safety net to keep yourself from pulling out money from your investments when life throws any sort of a curveball at you. Next section is about how we should not be looking at timing the market. A lot of people get trapped in that. But time in the market is more important than timing the market. You would have heard this. It sounds cliche, but it's as important as it can be. Even the best investors, I can tell you for sure, consistently cannot predict the markets in the short term. Instead, focus on this time you're staying in the market. Here's a mind blowing statistics. If you missed just the 10 best days in the stock market over the last 15 years, your returns would be half. Miss the best 30 days, you would have lost the money. Lesson: stay invested no matter what the headline screams. Or even better, don't even look at those headlines. Markets will fluctuate, there will be bad days, bad months, bad years also. But over the long term, markets tend to rise. That is what has been proven over for more than 40 years in Indian markets and for many, many more years in the more modern stock markets like the US. So embrace the ups and downs and remember the patience pays. Because one friend of mine, I remember, he keeps on asking me, why did the market go down today? So everybody wants to know why a market went down by 1% today, why Nifty was down by 1% today. But nobody questions why did Nifty go up by 4% today? Nobody questions that, right? So it's the market phenomena. It has to go up, it goes down. It's a demand supply problem. That's a topic for another video. But in essence, time in the market is more important than timing the market is the essence. Do not chase returns. So that's a rookie mistake, that even after choosing of a specific fund or a stocks, we tend to look at high recent returns and get tempted by, let us move from this one to this one or this stock to that stock, just because in the last 5 months it has been doing great. You see a fund delivering 40% returns in a year and think, I need to invest in that. But let me warn you, those returns are often unsustainable. Take the example of PPLTE mutual fund. It gave a stunning 45% return in the first year, luring many new investors. But the next 2 years, a disappointing 9% and subsequently 3%. Those who invested without a plan or research quickly pulled out, missing the 30% return in the following year. Moral of the story? Stick to your plan. Returns will fluctuate, but a disciplined investor always wins at the end. Next, one of the most important aspects of investing, keeping your emotions in check. Investing can be an emotional roller coaster, I must say. Markets hit their all time highs, investors panic and sell, thinking a crash is imminent. Markets fall, panic again. But here's the thing, your investments don't care about your emotions. Let's put this into perspective. Imagine you own a house worth rupees 2 crore. If someone tells you it's worth now 1.5 crore, would you sell it off? Of course not. So, why do you do the same thing with your stocks or mutual funds? Keep your emotions out of the equation. Market highs and lows are normal. Instead of reacting impulsively, focus on your long term goals and trust the process. Avoiding shiny objects is the next most important thing that most investors should be cautious of when coming into equity markets or any other sort of high return schemes, because new IPOs, new shiny NFOs from mutual funds keep coming and create buzzword around being a multi-bagger. That's the sector you would miss. It's all very tempting, but chasing the latest trends is a recipe for disaster. Successful investing is often boring. Instead of chasing the new next big thing, focus on quality. Companies like Asian Paints, Pidilite have consistently delivered strong returns. Again, Asian Paints may not be a right example for the current scenario, but yeah, they have delivered, whatever returns it has over a period of time. It has. It's not been performing over the recent few months for multiple reasons. That's a topic for another day. But not because these companies were revolutionary, but because they were reliable. Essential goods and steady performance win over flashy promises any day. So don't look for these kind of shiny objects. And finally, have faith in yourself. Believe in the markets, in your research. And once you have done your homework and chosen a good investment instrument, whatever it is, it's a specific index fund, it's a specific multi cap fund. We'll look at that in another video maybe. But whatever you have chosen, trust in that particular investment vehicle and be invested in that for a long period of time. If you're still unsure, there are options of investing in the broad market index like Nifty, Sensex, obviously what we call as index investing. And by doing that, you're betting on the economy itself. And let's be real, India as the world's fifth largest economy has a lot of growth ahead. Your investments will grow in the longer run. And one of the quotes I would like to quote over here from Mr. Rakesh Jhunjhunwala. Once someone asked Mr. Rakesh Jhunjhunwala, why are you not invested in crypto markets? That's such a big return opportunity that you're losing on. So he gave this beautiful answer where he said that I don't have to be in every party. I choose it and I'm fine with that. So do not create any sort of FOMO by looking at some specific stock, some specific mutual fund. You choose your party and avoid all this FOMO. That would be my last takeaway for today. And just to conclude all our topics to till now, to recap, start with a goal, invest consistently, ignore all the noise around, and above all, stay patient. Investing is not a sprint, it's a marathon. The earlier you start, the better your results would be. So, are you ready to begin your investment journey? Let us know your thoughts and questions or that you may have. Happy to answer those. And see you in the next video. Thank you.